On Wednesday, the 8th of March, 2023, Forbes magazine had Silicon Valley Bank on its Financial All-Stars list. The bank had $209 billion in assets, $175 billion in deposits, and had served the technology industry for 40 years. It was the 16th largest bank in the United States. By Friday morning, California regulators had seized it. The FDIC had been appointed receiver. Customers had attempted to withdraw $42 billion in a single day, a quarter of the bank's total deposits, and the bank could not produce the cash. It was the second largest bank failure in American history, and it had unfolded in under 48 hours. The first Twitter-fueled bank run in history. Silicon Valley Bank was founded in Santa Clara in 1983. Its model was simple and effective: serve the startup ecosystem. It banked venture capital firms, technology startups, biotech companies, and the founders who ran them. It offered specialized lending to companies that traditional banks wouldn't touch pre-revenue, pre-profit, burning cash in pursuit of growth. During the pandemic, the technology sector boomed. Venture capital investment surged. SVB's deposits nearly tripled, from $62 billion in early 2020 to $175 billion by the end of 2022. The bank needed to put that money to work. It made a decision that seemed reasonable at the time. It bought long-term U.S. Treasury bonds and mortgage-backed securities, locking in yields in a low-interest rate environment. Then the Federal Reserve raised interest rates 17 times in less than 2 years to combat inflation. When interest rates rise, the market value of existing long-term bonds falls because newer bonds pay higher yields. SVB's bond portfolio, worth $117 billion at the end of 2022, had accumulated over $15 billion in unrealized losses. The bank's chief risk officer had left in April 2022. A replacement was not named until January 2023. The position had been vacant for 9 months during the most consequential period of interest rate movement in decades. On March 8, SVB announced that it had sold $21 billion of its available-for-sale bond portfolio at a loss of $1.8 billion, and that it needed to raise $2.25 billion in new equity to shore up its balance sheet. The announcement was handled badly. Instead of being managed quietly, perhaps pre-arranged with a large cornerstone investor, it went out as a public statement that immediately signaled weakness. The same day, Moody's downgraded SVB's credit rating. The combination, a large loss, a rushed capital raise, a credit downgrade, was immediately visible to exactly the wrong audience: the tight-knit community of venture capitalists, startup founders, and technology investors who were SVB's entire customer base, and who all followed the same Twitter accounts, read the same newsletters, and talked to each other constantly. A finance newsletter called The Diff had flagged SVB's balance sheet vulnerability in February, noting the bank was technically insolvent on a mark-to-market basis. That observation, shared on Twitter, was read by virtually every venture capitalist in Silicon Valley. When the March 8 announcement dropped, the VC group chats lit up. Peter Thiel's Founders Fund advised its portfolio companies to withdraw deposits and pulled its own funds entirely. Union Square Ventures and Coa2 Management did the same. The advice spread instantly through encrypted group chats and Twitter. By the morning of March 9, the information environment had turned SVB into a crisis. On March 9, SVB's shares fell 60%. CEO Greg Becker held a call with clients urging them to stay calm. The message had the opposite effect. By the close of business, customers had submitted withdrawal requests totaling $42 billion, a quarter of the bank's total deposits in a single day. The bank's systems were struggling. It ended the day with a negative cash balance of nearly $1 billion. The speed of the run was unlike anything in banking history. Traditional bank runs, the kind that happened in the 1930s, took days or weeks as depositors physically queued at branches. This one happened in hours, coordinated by text messages and Twitter posts, executed through digital banking apps. There was no queue. There was no visible panic. There were just transfer requests, cascading through the system faster than the bank could respond. On the morning of March 10, trading in SVB shares was halted before the market opened. California regulators seized the bank at 10:45 a.m. The FDIC was appointed receiver. Employees received their annual bonuses paid automatically by the payroll system hours before the government took control. The bank that had been on the Forbes All-Stars list 48 hours earlier was gone. Over the weekend, the U.S. government moved quickly. The FDIC, Treasury Department, and Federal Reserve announced jointly on Sunday, March 12, that all SVB depositors, whether their funds were insured or not, would have full access to their money on Monday morning. The FDIC's standard insurance limit is $250,000 per account. 86% of SVB's deposits were above that limit. The decision to cover everyone was extraordinary, driven by fear that allowing large uninsured depositors to lose money would trigger runs on other regional banks. The moral hazard argument is real. If depositors know the government will bail out uninsured deposits in a systemic crisis, they have less incentive to monitor the health of the banks they use. SVB's customers were sophisticated investors in companies, the kind of parties who should have been paying attention to the bank's balance sheet. Most of them weren't. They were earning above market rates on their deposits and assuming the system would protect them. The broader lesson of SVB is not about fraud. Nobody stole anything. The bank made a bet on interest rates staying low, managed its risk badly, communicated a problem worse than it needed to, and was then killed by the speed of the information environment it served. The tech industry built the tools that destroyed the bank that served the tech industry. 40 years of institutional history, 48 hours, $42 billion. That's where the money really went. This was Dark Ledger. Subscribe if you want to know where else the money really went.